A shocking financial move is sending shockwaves across the globe. China has just executed an exit maneuver worth $170 billion, leaving experts scratching their heads and markets on edge. But the big question is, what's behind this massive exit, and what does it mean for the future of our economy? Stick with me till the end as we unravel the mysteries of China's game-changing move and explore its potential impact on the global stage. Before we dive in, please take a moment to subscribe to our channel. We bring you the latest news and analysis on everything from global economies to the stock market and personal finance. Hit that bell icon so you never miss an update. Now let's get back to the show. Brace yourself because the world's second largest economy is pulling out a staggering $170 billion from the United States. This massive exodus has left economists and investors both puzzled and concerned. But fear not, because today we are diving deep into the reasons behind China's shocking move and exploring its potential ramifications for the global economy. In this eye-opening, you'll uncover the key factors driving China's withdrawal of $170 billion from the U.S. and analyze how this strategic decision could shape the future of international finance. So buckle up and join us as we navigate the twists and turns of this financial thriller. You might be wondering why China is pulling away billions of dollars from the U.S. economy. Well, there are several complex factors at play. Let's start with the ongoing trade dispute between the two superpowers. As tensions rise, China may be diversifying its investments to reduce its reliance on the U.S. Additionally, China's growing influence on the global stage could be a motivating factor. By reducing its holdings of U.S. Treasuries, China may be signaling its desire for a larger say in global financial systems. But that's not all. China's massive exit from the U.S. economy could also be attributed to the country's shifting monetary policy. With a focus on stimulating domestic growth, China may be shifting its investment strategy to prioritize its own economy. Furthermore, geopolitical events such as the Russia-Ukraine conflict could be influencing China. As decision to diversify its investments and reduce its exposure to Western markets, it's important to consider these complex factors to gain a comprehensive understanding of China. As actions and their potential implications for the global economy, China's decision to reduce its holdings of U.S. Treasuries has sent shockwaves through the global financial system. With geopolitical tensions rising and economic uncertainties looming, investors are on edge. Now, what exactly does China's move mean for the future of our economy? Will it trigger a market meltdown, or is it simply a strategic business decision? Let's delve deeper into the potential ramifications of China's actions. One significant concern is the impact on U.S. Treasury prices and yields. As China reduces its holdings, there could be downward pressure on Treasury prices leading to higher yields. This could affect borrowing costs for the U.S. government and have broader implications for the economy. Additionally, the move may signal a loss of confidence in the U.S. economy, potentially impacting investor sentiment and triggering market volatility. Moreover, the reduced demand for U.S. Treasuries could affect the Federal Reserve's monetary policy, potentially complicating efforts to control inflation or stimulate economic growth. It's crucial to closely monitor these developments as they could have profound consequences for the future of our economy. The recent revelations about China's reduced holdings of U.S. Treasuries left investors and economists scrambling for answers. Why is China offloading its investments, and what does it mean for the future of the global economy? To shed light on this perplexing development, we spoke with respected economist Dr. Jeffrey Snyder. His insights provide a fascinating perspective on the complex factors driving China's decision. According to Dr. Snyder, China's reduction in U.S. Treasury holdings can be attributed to a combination of various influences. One significant factor is the escalating trade conflict between China and the West, particularly with the United States. As tensions rise, China may be seeking to safeguard its assets and reduce its exposure to potential risks associated with holding large amounts of U.S. Treasuries. Additionally, Dr. Snyder highlights the impact of changing global dynamics. China's growing economic influence and its expanding role in international finance could be contributing to its decision to diversify its investment portfolio and reduce its reliance on U.S. assets. He emphasizes that this shift should not be viewed solely through the lens of the current administration's policies, but rather as part of a long-term trend driven by fundamental changes in the global economic landscape. As Dr. Snyder points out, China's actions reflect a strategic move towards greater self-reliance and a desire for a more prominent voice in global financial matters. Understanding these motivations is crucial for navigating the complexities of international economics and anticipating future developments. Recent data reveals that China's holdings of U.S. Treasuries have plummeted to their lowest point since 2009. This drastic reduction raises concerns about the future of the U.S. economy and its implications for global financial markets. But what does this decline in Chinese investment signify, and what challenges does it pose for the United States? Let's explore these pressing questions and delve deeper into the implications of China's actions. One key concern is the impact on U.S. borrowing costs. As China reduces its holdings of U.S. Treasuries, there could be increased downward pressure on Treasury prices, leading to higher borrowing costs for the government. This could have broader implications for fiscal policy and the overall economy. Additionally, the decline in Chinese investment may signal a loss of confidence in the U.S. economy, potentially affecting investor sentiment and contributing to market volatility. Moreover, it could strain the U.S. relationship with one of its largest trading partners, leading to heightened geopolitical tensions. As the world's two largest economies continue to compete, finding common ground and fostering cooperation becomes crucial for global economic stability. Navigating these challenges requires careful consideration of the factors driving China's decision and exploring potential solutions to mitigate risks and promote a stable global financial system. In a surprising turn of events, Saudi Arabia has emerged as China's top trading partner, overtaking the United States. This unexpected development has raised questions about the shifting dynamics in global trade and the implications for both countries. But what does this development signify, and how will it impact the future of their economic relationship? Let's delve into the details and explore the potential ramifications of this remarkable shift. Saudi Arabia's rise to the top trading partner position reflects several key factors. The strong growth of the Chinese economy and its increasing demand for energy and raw materials have contributed significantly to this development. Saudi Arabia, with its vast oil reserves and strategic importance as an energy supplier, has been able to capitalize on this demand. Additionally, the close relationship between Saudi Arabia and China, including substantial investments and cooperation in various sectors, has played a pivotal role. Unlike the United States, which has imposed sanctions and taken an adversarial stance towards China, Saudi Arabia has chosen to deepen its ties with Beijing, viewing them as an opportunity for economic growth and diversification. This shift in priorities has led to a surge in bilateral trade between the two nations, solidifying Saudi Arabia's position as China's top trading partner. However, this development presents challenges for the United States. Losing its top trading partner status to Saudi Arabia underscores the importance of diversifying trading relationships and addressing geopolitical tensions. The U.S. will need to reevaluate its economic policies and find ways to foster closer ties with strategic partners to maintain its position in the global economy. Ultimately, the evolving dynamics in global trade highlight the need for adaptability and cooperation in an increasingly interconnected world. China's recent decision to reduce its holdings of U.S. Treasuries by $170 billion has sent ripples throughout the global financial market, but amidst these uncertainties, there is a glimmer of hope for investors seeking to navigate these turbulent waters. According to renowned financial expert, reputable sources reveal that now is the time to consider investing in gold and silver. These precious metals have historically served as safe havens during times of economic uncertainty and geopolitical tensions. Furthermore, renowned financial expert highlights that investing in gold and silver can provide several advantages. Firstly, these metals tend to perform well during inflationary periods, making them an attractive option when traditional assets face headwinds. Additionally, gold and silver have low correlation with stocks and bonds, which means they can offer diversification benefits to a portfolio. Moreover, these assets have inherent value and are considered tangible wealth, providing investors with a sense of security and stability. However, it is essential to consult with a financial advisor before making any investment decisions and consider factors such as market volatility, storage costs, and insurance when incorporating gold and silver into a portfolio. In conclusion, while China's actions may pose challenges and uncertainties for the U.S. economy, also presents an opportunity for investors to explore alternative asset classes such as gold and silver. By diversifying their portfolios and consulting with financial experts, investors can navigate these turbulent times and position themselves for long-term success. In a shocking revelation, sources have uncovered that China may be preparing for a looming economic warfare with the United States. This alarming development comes as tensions escalate between the two superpowers and raises concerns about the potential impact on global financial stability. But what are the signs indicating China's preparedness for economic warfare, and how might it unfold in the near future? Let's delve into the details and explore the strategies China is undertaking to safeguard its economic interests. One indication of China's preparations for economic warfare is its efforts to secure alternative sources of financing. By reducing its holdings of U.S. Treasuries and increasing investments in other assets, China is diversifying its portfolio and mitigating risks associated with relying heavily on the U.S. financial system. Additionally, China's Belt and Road Initiative, which involves extensive infrastructure projects across the globe, is seen as a way to expand its economic influence and reduce dependence on Western markets. Moreover, China's growing collaboration with countries like Russia, Iran, and North Korea demonstrates a strategic move to form alliances and access new markets and resources. These steps allow China to insulate itself from potential economic sanctions or trade wars initiated by the United States. It's crucial to understand the motivations and actions driving China's behavior in order to navigate this complex economic landscape and anticipate potential challenges. As the world witnesses China's bold move to reduce its holdings of U.S. Treasuries by an astonishing $170 billion, many are left wondering about the future of the U.S. economy. Will this significant shift have far-reaching consequences? Or is it simply a strategic business decision? Renowned economist Dr. Richard Duncan sheds light on this perplexing development, offering valuable insights into the potential ramifications for the U.S. economy. Dr. Duncan suggests that China's decision to divest from U.S. Treasuries reflects a loss of confidence in the U.S. economy and financial system. He highlights that years of excessive borrowing and deficit spending have resulted in a mountain of debt, raising concerns about the U.S. ability to repay its obligations. Moreover, Dr. Duncan points out that the current geopolitical tensions and conflicts further exacerbate these concerns, creating an environment of uncertainty and risk for investors. China's move to diversify its portfolio and seek safer investments in assets such as gold and commodities is a prudent strategy to mitigate potential losses and protect its financial interests. However, Dr. Duncan warns that the implications extend beyond just the U.S. economy. The reduced demand for U.S. Treasuries could lead to higher interest rates, making it more expensive for the government to finance its deficit. Additionally, it could impact the value of the U.S. dollar, potentially leading to inflation and economic instability. The U.S. needs to address its fiscal imbalances and work towards reducing its national debt to restore investor confidence and maintain its position as a global economic leader. If you enjoyed this video, make sure to stay tuned for more informative content. Don't forget to hit that like button and share this video with your friends. We would love to hear your thoughts in the comments below. Thanks for watching.